Many people register an LLC believing that it automatically lowers their overall tax bill. That is simply a myth. Unless you file a specific tax election, the IRS treats a single-member LLC identically to a sole proprietorship. You get no special tax treatment by default. The financial consequence is direct. Every single dollar of your net profit is subject to a flat 15.3% self-employment tax. This diagram illustrates a $100,000 profit block. Notice how the 15.3% cut is taken out immediately, before standard income taxes are calculated. This tax is mandatory because the IRS requires you to fund both employer and employee contributions for Social Security and Medicare. A default LLC provides vital legal protection for your personal assets, but it offers zero tax optimization. Your income remains fully exposed to maximum taxation. If you spend time in business forums online, you will see one specific strategy heavily promoted to escape that 15.3% tax: the S-Corp election. Online advisors often present the S-Corp as a magic wand that instantly saves business owners thousands of dollars overnight. Adopting this tax structure requires you to implement a highly regulated corporate framework that comes with strict, mandatory administrative costs. The core dilemma is not whether an S-Corp saves money. The question is, at what exact profit number those tax savings actually outpace the steep cost of running the corporation? Choosing to become an S-Corp is not a matter of business philosophy. It is a strict ROI math equation based entirely on your annual net profit. When you file an S-Corp election, your legal status changes. You become a W-2 employee of your own company. This legal shift splits your business's net profit into two distinct buckets: W-2 salary and owner distributions. This animation shows a single stream of business revenue flowing downward and splitting into two separate reservoirs. The 15.3% payroll tax is now only applied to the money inside the salary bucket. The money in the owner distributions reservoir passes through to you completely untouched by the self-employment tax. The volume of profit you can legally funnel into tax-free distributions, rather than salary, is the sole engine of S-Corp tax savings. You might look at this setup and think you can pay yourself a tiny $10,000 salary and take the rest as tax-free distributions. The IRS anticipates this. They enforce a reasonable salary rule, specifically to prevent business owners from artificially dodging payroll taxes. The IRS requires your compensation to align with fair market industry standards for the work you do. In practice, this usually absorbs 35 to 60% of your net profit. If you violate this rule, the IRS can reclassify your distributions as wages, triggering heavy back tax penalties and interest. You cannot cheat the salary ratio. To realize actual tax savings, your total profit must be large enough to leave a substantial distribution after you pay yourself a legally defensible wage. Transitioning to this tax status also introduces a financial reality called compliance drag. You are now required to run official W-2 payroll software throughout the year and file a highly complex Form 1120S corporate tax return. Between the payroll processing subscriptions and premium CPA fees, this compliance drag typically costs between $1,500 and $3,500 annually. This ledger subtracts baseline operational costs from your potential gross tax savings, revealing a much lower net benefit. You also factor in state-level entity fees. A California S-Corp pays a minimum $800 franchise tax, or 1.5% of net income. If your business profit isn't high enough to generate tax savings that exceed these fixed annual costs, electing S-Corp status will actually cause you to lose money. The decision to switch structures comes down to finding the break-even point, the exact moment where your tax savings finally cross above the compliance dragline. This graph compares the exact cost of a sole proprietor's tax burden against an S-Corp's combined tax and fee burden as net profit scales upward. The two trajectories intersect right in the $60,000 to $80,000 net profit mark. Below that intersection, the S-Corp structure is operating at a loss. Above the intersection, the S-Corp starts keeping money in your pocket. That $60,000 to $80,000 range is the mathematical threshold where the friction of operating an S-Corp finally pays off in real dollars. Using this math, we can build a decision framework that categorizes business owners into three specific income tiers. This flowchart starts with businesses earning under $40,000 in net profit. At this tier, you should stay a default LLC. Any minor tax savings will be wiped out by the compliance costs, putting your business in the red. The middle tier is the $40,000 to $80,000 transition zone. The S-Corp math might technically save you $500 to $1,000 here. You have to weigh if that minor margin is worth the massive increase in administrative headaches. The final tier is for businesses earning a net profit of $80,000 and above. At this tier, the structure becomes highly optimal. Your business absorbs the compliance costs easily, reliably saving you thousands of dollars or more every year. Think of the S-Corp as a financial upgrade earned only once your revenue officially scales past the break-even threshold.